Today we want to continue our discussion of these interest rate differentials where we talked about an interest rate on a specific loan. And we said that it is comprised of two things. One is this general interest rate environment that is shared throughout the economy, and that came from this supply and demand situation that we discussed earlier, the loanable funds model. Plus, then what we have are interest rate differentials. Associated with the specific loan. Okay, and so a real estate loan is different than a car loan, and a short-term loan is different than a long-term loan. Risky loans different than safe loans, and so forth. And so that's what we're talking about now, are these differentials. What will happen is this, is that over time, interest rates will move as a family. And so if the interest rate environment, that climate that everybody shares, if it's causing interest rates to go up and down over time, then other interest rates will move up and down with it in more or less the same pattern, but at different heights. And so this might be the interest rate on riskier loans, and this one might be interest rate on less risky loans, and there will be others on shorter term loans versus longer term loans, but they're all following this general pattern from the interest rate environment, and that is that loanable funds model that we had. Okay? And so anyway, what we talked about already is the impact of risk or default risk. And you remember we talked about last time about the credit ratings from Moody's and Standard & Poor's, and then the credit scores. I looked at that also. The credit scores for individuals ranges from 300 to, was it 850? And so anyway, but those would apply more to an individual versus these AAA, AA, single A, and so forth. That would apply to corporations and governmental borrowers. So anyway, that's what we talked about last time. This time what we want to do is we want to talk about term to maturity and the impact term has on interest rates. Okay, now there's a simple answer to this. There is no simple answer to what impact term has on interest rates. It depends. It varies over time. If we go get a bond page from the Wall Street Journal or New York Times, we'll say Treasury bonds. What we'll see on that table is different maturities, like 1 month from now. That would be a maturity on a Treasury security, and it will carry a yield. So let me put here term and then yield, and it'll carry a certain yield, and let's say 1%. And I'm using hypothetical numbers. There will be other terms, and by the way, there are dozens and dozens and dozens of different issues of Treasury security and different maturities. And so as we just go down here, there will be 2 months, 3 months, 4 months, and so forth. Let's say 6 month, maybe it'll be 1.5%, and maybe 12-month maturities, there will be a 2.5%. 2-year maturities, or 24 months, 4%. 5 years, 6%. 10 years, 6.5%. Where am I getting these numbers? Well, just making them up. 30 years, 8.1%. Now, here's the thing about all of these securities. If we're just looking at Treasury securities, they all have the same amount of default risk, right? Which is minimal. There's always a chance that humanity as we know it would be destroyed, or that, I don't know, Mexico would conquer the United States and abrogate all the debts and so forth. There's chances that stuff can happen, but very unlikely, and so it's pretty likely that the government's going to honor its, and the federal government is going to honor its obligations. So the same amount of default risk on all of these. And in terms of the marketability, the trading market, the market's open every day for these securities, and there's an active market for all these securities. There's really not much difference in these securities except for one, and that one main difference is term to maturity. And so, there's this term economists always use, ceteris paribus, other things being equal. Here, other things are equal between all these securities and term to and the only thing that varies is term to maturity. Otherwise, these are the same. And so if we came and got these numbers, here's term that we'll put on our horizontal axis. If we came and got these interest rates, then what we'd say is 1 month, and it looks like, oh, there's 1%. And put a dot up here. And I'm not going to try and get all these dots out there. Let's look at 1 year. And it looks to me like 2.5%. Put a dot out there. You remember our term basis points? What we'd say is here, there's from 1 month out to 1 year, it's plus 150 basis points, right? It rises by 1.5%. Let's say 5 years. And then this would be, with the numbers we're using here, here's 6%. How many basis points? So next to 3.5%, it's 350 basis points. These are huge gaps that I'm talking about here, plus 350 basis points. That's a lot. In reality, you seldom would ever see that. And let's just take the last one, 30 years and 8.1%. How many basis points? 210, right? And put a dot out here. Now, in reality, there are, as I say, dozens, scores, I don't even know, maybe a couple hundred, I'm not sure how many different issues of Treasury securities. And so in reality, we would have so many dots out here that there wouldn't be these big gaps. But these dots kind of trace out a relationship between term to maturity and yield. And this thing is called a yield curve. Wall Street Journal and other publications, they've got software, and basically what you see with that software is just all kinds of dots out there. There are so many of these different securities. And what they'll do is their software will trace a line through there that is the closest fit, and it's usually curved. Anyway, then we get a yield curve, and this tells us the relationship between term to maturity and yield. And what this says is longer term loans and investments have a higher yield, a higher interest rate than shorter term loans and investments. That's what it says. And if you go get the newspaper, let's say for the next 1,000 days, what you're going to find is that out of probably 900 or 950, probably not 950, but 900 out of the next 1,000 days, you're going to see an upward sloping yield curve. And this is the most common relationship between term to maturity and yield. There's a positive relationship. Longer term loans, higher interest rates. Shorter term loans, lower interest rates. And that doesn't just apply to Treasury securities. It also applies in general to home loans, for example, or car loans. In general, if you go and price some car loans, call up 2 or 3 banks and say, hey, how much for a car loan with a 3-year maturity, a 4-year, 5-year, 6-year? And you find out that, hey, the longer the term, the higher the interest rate. You go and price a bunch of home loans, 15-year, 20-year, 30-year, and you'll find out generally, the longer the term, and by generally, I mean you'll find that out today, but if you do this, once a week for the next 10 years, 20 years, you're going to find out that it's almost always that way. Longer term loans, higher yields, higher interest rates. But it's not always that way. Here's what we sometimes see. Sometimes we see a horizontal yield curve. It's flat. There are times that we see a yield curve with a little bit of a hump in it. Sometimes it's just a yield curve that has a negative slope. So it's not always upward sloping, sometimes downward sloping. And The truth of the matter is there is no general rule. It has to look this way or it has to look that way. What happens is people observe something, like I say, 900 times out of 1,000, and then they come to that conclusion, hey, that's what it looks like. Well, not really, because there are things that affect that. And in fact, that's why we're here today, is talking about what is it that will determine the shape of the yield curve. Okay? And don't forget, we're interested in talking about factors that influence specific interest rates. And so now what we want to do is talk about not risk, but we want to talk about term. So how does term to maturity affect interest rates? And the answer is, usually it's a positive relationship, but not always. And so since it's not always the same, then we need to kind of have some understanding of why it varies over time. This is a pretty interesting subject, at least from my perspective. Here is something called the expectations theory. That is pretty important. It's theoretical, but also it's got a foundation in the real world. Here's what it says, is that the interest rate, let's say the long-term interest rate, is an average of today's short-term interest rate and short-term interest rates expected to prevail in the future. And I purposely added one more word in here, but kind of threw it off to the side, into the relevant future. I don't mean to say for thousands of years out or any sort of random future, but over a relevant period. And I'll make that clear what I mean in just a minute. And I've underlined a few words here that maybe you want to focus on. I'm going to focus on it in my discussion. Long-term interest rate. Here's what this says. The long-term interest rate doesn't have an independent existence. You see that? This doesn't say, oh, there is a long-term credit market and it's got its own interest rate. That's not what this says. It says the long-term interest rate is dependent on short-term interest rates. It says the long-term interest rate is just going to be an average of the short-term interest rate today and the short-term interest rates that we expect in the future. And so let's just talk about a simple example. Here's today. And let's talk about a simple example of 2 years, a 2-year period. A 2-year period, of course, is 2 one-year periods added together. That's math. And so if we just kind of said, hey, what's the interest rate on a 2-year loan? And the answer is, we don't know yet, according to this expectations theory. If today a 1-year loan has an interest rate of, let's say, 4%, and then we expect that 1 year hence, 1 year from today, we all got together and said, hey, what's the interest rate going to be at that point? That would be another 1-year loan. Today we have an expectation of what that rate's going to be. Do we know? No, nobody knows. Anybody who knows can just become the wealthiest person on earth by speculating in bonds. Anybody knows what that rate's going to be? That would be like if somebody said to you, hey, I know what the price of General Electric stock will be a year from today. Well, if you do, you can get rich. Well, if you knew what interest rates are going to be a year from today, you can get rich from that. You can speculate in those markets. You remember the idea of interest rate risk, right? If you know if interest rates are going up or down, you know what's going to happen to bond prices. They're going to move in the opposite direction. So we don't know. Here's what this says, though. Expect. When do we expect it? Today. Today's expectation of the 1-year rate 1 year from today. And let's just say that I can snap my fingers and everybody in the United States, everybody in the world suddenly say, hey, you know what? I think 1 year from today, interest rates will be, let's say, 6% on a 1-year loan. As soon as I snap my fingers, everybody thinks it's 6%. You know, today they're 4%, but I think they'll be 6% in the future. Then here's what the expectation theory says. It says that the 2-year interest rate, 2-year rate, let's say today's 2-year rate, standing right here, 2-year interest rate today would be 5%. An average of today's short-term rate and the short-term rate we expect in the future. Now, why? An answer, supply and demand. Of course, supply and demand answers everything, doesn't it? Supply and demand. Let's just say it weren't. Today's rate is 4%, and we do expect 6%. We're not going to mess with that. But let's say that this interest rate were 7%, hypothetically, on a 2-year loan. Today's interest rate, 2-year loan, 7%. And now we'll have some mutual fund company or some pension manager, some insurance company. They're sitting over here with $1 billion, and they're going to lend this money out. And what they would say with their $1 billion is, let's see. I can loan my money out short term. On $1 billion, I get 4%. That'd be $40 million in the first year of interest. I think that when that loan is up and I get paid back, I'll have another $1 billion. I think I'll get 6% then. 6% of my $1 billion would be $60 million. So if I would loan my money out for 1 year plus 1 year, this is my long-term loan, 2 short-term loans, I would get 40 plus 60, I get $100 million. Hey, that's pretty good. $100 million. But then this same pension manager, insurance executive and so forth, they say, hey, I got $1 billion. What if I loan that out for 2 years? I get 7%, I get $70 million this year, $70 million next year. I get $140 million. You know, that sounds better. I think I'll do that. And so what they would do is flood the market with this 2-year loans. There would be like, no more 1-year loans, 2-year, 2-year, 2-year. Then there'd be a huge increase in the supply. And by the way, we were doing this last time. I don't want to overemphasize it this time, but where we were talking about, you know, the impact of risk, and I was showing the supply of credit shifting. Well, what we would have in this case is the supply of credit would shift away from 1-year loans toward 2-year loans. And then that massive influx of new credit, new supplies of credit, would bring down those long-term interest rates. So you just cannot have a long-term interest rate that's different from this average. Suppose it's the other way around. Suppose that this was 3%. Suppose today's 2-year rate is 3%, and then today's 1-year rate's 4%, and we expect, what, 6% next year at this time. Then we'd say, oh, I got $1 billion, I get 4 plus 6, I get $100 million. If I loan for 2 years, I get 30 million, 60 million. Uh-oh. Nobody would loan long-term in this situation. The supply of credit would be withdrawn from the long-term market, and that reduction in supply of credit would cause the price to go up, the interest rate. And so what's going to happen is these massive flows, we are talking about credit markets now where $1 billion investments are not huge. There are hundreds of investors in the world that have $1 billion to invest. And so to move $1 billion around, that's not a big deal. And so if you think that this rate right here, the long rate, is not an average of today's short rate and the short rate we expect in the future, if you think that's not true, you move your money one way or the other. You either move it into the long market if this rate's too high, or you move it out of the long market in the short rate market if this rate's too low. And then once those dollars have stopped moving, once suppliers say, or lenders, okay, I'm comfortable with this, they stop when they say, I don't really care, I could flip a coin. I'm okay with long-term or short-term, I don't care. And that would be, if it's 5%, here's an average, then what happens is you got $1 billion, you go, well, you know, I'm going to get $40 million here, I'm going to get $60 million there, that's $100 million. Or I get 50 plus 50, that's $100 million. Nah, I don't care. And at that point, the massive flows of credit stop. And it's what we'd call an equilibrium situation. So in equilibrium, the long-term interest rate is an average of today's short rate and the short rate we expect in the future. Okay? Now, let's say we look at this situation just the way I've got it written down. What's the yield curve look like in this picture? First of all, that yield curve that I drew a few minutes ago, the yield curve is actual interest rates that are observable. It's not in our heads, not what we expect, what we observe. And in this little picture I have right here, we've got two interest rates that are observable. Today's short-term interest rate, one-year rate, and today's two-year interest rate. And so if we draw a yield curve, term to maturity here, and interest rate here, if we draw a yield curve, what we see is this. 1 year yields 4%. 2 year yield 5%. So now we have an upward sloping yield curve. Let's look at this rate. The 2-year interest rate's 5%. This is an average of 4, I'll say average of 4 plus something, and that's 5%, right? What is that something? It's got to be 6, right? 4 and something, average 5, that's something 6. So if we have an upward sloping yield curve, if the long-term interest rate is above the short-term interest rate, it must be because that something is higher than that 4. So if we see an upward sloping yield curve, then that can only be caused, under this explanation, under this story, it can only be caused if lenders expect short-term interest rates to rise in the future above today's levels. If we don't expect that, if we thought the short-term interest rate would stay where it is today, 4 plus 4 don't average 5. 4 plus something bigger than 4 is what creates that 5. And so the only way to get an upward sloping yield curve is for us to expect higher short-term interest rates. Okay. Suppose we had a downward sloping yield curve. I put a case of that up a moment ago, but let me go back and do this again. Well, one-year interest rate maybe is 4%, 2-year interest rate maybe at 3%. We pick up the newspaper. It says to us this: 1-year Treasury securities are yielding 4%. 2-year Treasury securities yielding 3%. How can that be? Well, this rate, the long-term interest rate, is an average of today's short-term interest rate and the short-term interest rate we expect in the future. 4 plus something average 3. That something's got to be less than 4. If that were a 4, 4 and 4 average out to 4. So for 4 and something to average out to 3, then that something has got to be below where it is today. So we expect short-term interest rates to go down in the future. To where? 2, right? So the only way to get a downward sloping, this is a negatively sloped yield curve, the only way to get that is if lenders expect short-term interest rates to decline below today's levels. Now, I don't want the next thing to, you can go in your notes if you want, but I'm not going to test you on it because it's a complication that if you were an investor, it would make a big difference if you had $100 million or $1 billion to invest. But for you to understand the theory of it, this is what you need to know. But I'm going to tell you one more thing, and it's this. What I'm telling you right now is not strictly true, but it's kind of true, but not strictly true. And here's why not. Let me go back to the story I had a minute ago. Hey, I've got $1 billion. If I invest, whatever I had here before, let's put this as, well, I'll leave that at 5. If I've got $1 billion, I'm not really indifferent between these two approaches. If I've got $1 billion, I say, look, I get $40 million interest in the first year. I'd get $60 million of interest in the second year. That's 100. If I go with the longer term approach, I get 50-50. Would you rather have $40 million in the first year and $60 million in the second, or $50 million in each year? They both add up to 100. When do you want your money, sooner or later? Sooner. So really, we're not indifferent here. But the story is best if we leave it at that point. And this is what we would call, wherever I wrote this down, where I said it's an average. The way I've told the story, I've said this is an arithmetic average. That's the way I'm telling the story, where 5 is an average of 4 and 6. And 5 is an average of 4 and 6 if you do the math the way you learned in grade school. But when we allow for compounding, when we allow for the time value of money to enter into this, then 40 million plus 60 million is not as good as 50 million plus 50 million. And so what you would do in that case to actually be accurate, 100% accurate, is we would use something else called a geometric mean or average rather than an arithmetic mean or an average. And so I'm just telling you that even though it seems like I don't know any different between these two, I do know the difference, and I do know that what I'm telling you is not exactly true, but it's pretty close. If somebody said, would you rather have $4 plus 6 or $5 plus 5, you almost don't care. But when we start talking about millions and millions and stuff, and with the rates, it doesn't make any difference whether it's 4 and 6 or 5 and 5 versus 40, 60, 50, 50. The percentages, it doesn't make any difference, but in terms of how much do you care, not much if we're just talking about a few dollars, $10 and so forth. Anyway, but to allow for the compounding, this is really, it's a more sophisticated approach. We would be doing 1 plus the interest rate in the first year multiplied by 1 plus the expected interest rate for the second year equals 1 plus the 2-year interest rate. This is where we start getting the compounding in there. Don't put this in your notes unless you just enjoy having a bunch of trivia in your notes. But I'm just saying to you that The way you would do it with an arithmetic mean, I1 plus I2E equals R2, and I guess it would be divided by 2, and then you'd be done. That's arithmetic mean. But here, with the geometric mean, it's a little more complicated. And so I'm just saying to you that the way we're telling the story here is the simplest possible way. And it's not 100% accurate, but the theory of it, the idea of it is exactly right. And that's what you should focus on. And we will always, like on test day and stuff like that, we'll be using the arithmetic mean where 4 plus 6 average 5, and that's the end of the story. But in reality, 4 plus 6 don't average 5. When we're talking about this geometric mean, it would be a little bit different than 5. It might be 4.97% or some number like that. Okay? What about a 30-year loan? Well, let's just say a 3-year loan. We've got an interest rate that's 3 years, and what I'm saying is that would be an average of 3 things. It would be an average of today's short-term interest rate. It would be, a second item would be the short-term interest rate, the 1-year interest rate that we expect to prevail 1 year from today. And then another short-term interest rate that we expect to prevail 2 years from today. And so we've got this 3-year period, okay, and we've got a short-term interest rate today. Let's say it's 4. Let's say that we expect the short-term interest rate to be 6 2 years from today. And then we expect the short-term interest rate to be, I don't know, let's say 7. Did I say 2 years? 4% today. We expect that 1-year rate to be 6% 1 year from today. We expect the 1-year rate to be 7% 2 years from today. And so then the alternative would be make one long-term loan for 3 years. So 17% divided by 3 is how much? 5.67%. And that would be, using an arithmetic mean, that would be the average. That would be our 3-year interest rate. Okay? What's our yield curve look like? 1 year, 4%. What's our 2-year interest rate? Anybody? Anybody? Bueller? That's from Ferris Bueller's Day Off. What's a 2-year interest rate here? 5. How'd you know that? 4 and 6 average 5. Okay, so 5. What's our 3-year interest rate? 5.67, right? Let's go out another year. Let's say on this day, that would be 3 years hence, 3 years from today, we expect that short-term interest rate to be, I don't know, let's say 6% again. So what do we have? We have 23 divided by 4 equals 6.75? 5.75? Help me out here. I added 23, 5.75, right? Okay, you want to add one more? 4. Let's say that 1, 2, 3, 4 years from today, we think the short-term interest rate would be 4%. Now, 27 divided by 5 equals, what would this be? 4, 5.4. And so now if I trace my yield curve out, here's a yield curve that rises and it starts to drop off. This is what we see today. This is the 1 year yield 1 year hence, 2 years hence, 3 years hence, and then 4 years hence. And so our expectations about the future would tell us that, oh, now we have a yield curve that rises for the first, what would it be, 3 years out, 4 years out, and then starts dropping off. And you see, what happened really was this, is that we really thought that after, 2 years out, that interest rates, short-term rates, would start dropping off, right? But our yield curve continued having a positive slope on it all the way out for 4 years. Do people have expectations about interest rates 3 or 4 years away? And the answer is, yeah, of course they do. Those expectations have a different nature, though. If you just ask me what I think interest rates will do over the next 6 months, I'll be thinking a lot about current policy and what's the economy doing today. We talked last time about a pro-cyclical pattern in interest rates, right? Or I might think about what's happening overseas, what's happening to the value of the dollar, the economies overseas. I might think about things like that. But if I start thinking about what are interest rates going to do in 3 or 5 or 10 or 15 or 20 years, who knows what's going to happen with those things? Then we start thinking about institutional types of issues. It's like, what's the Federal Reserve committed to? What's happening with fiscal policy, the President and the Congress, and what kind of things are they doing now that maybe will have a lasting impact? For the last couple of decades, the Federal Reserve has been committed to fighting inflation, keeping inflation down, and not every day, every month, but at least trying to bring it into line with 1 to 2% inflation. That has been their commitment, their number one commitment. And so what I say is this: as long as the Federal Reserve has that commitment, as far as I know, legislation hasn't changed that would influence the Federal Reserve and make them commit to some other inflation target. The people who work at the Federal Reserve, the top officials, they have PhDs in economics. They are sort of being brought up, being trained the same thing at different universities, but more or less the evils of inflation. So what I say is, I kind of think the Federal Reserve's committed to inflation over the long run, 1 or 2%. And if I think that, then that's going to shape my expectations of what's going to happen to, right? The Fisher equation tells us how inflation figures into this whole interest rate story. So that kind of figures into what I think interest rates are going to do 5 or 10 years down the road, 20 years down the road. And so our expectations are different. And maybe you never think about it, but on the other hand, you're neither an economist nor a person who manages $100 million of money. But if you started having to manage $100 million worth of money and somebody said to you, hey, what are you going to do with this long-term money? You'd start forming expectations about the future. Why? Because you have to. You don't have a choice. Somebody who does think about those things will get your job. So then you will think about them. But the point is that once you start thinking way down the road, you'll build other things into your thinking, not just what's going on today. If somebody asks me about the stock market, what's going to happen to stock prices over the next 10 or 20 years? Right now I might be thinking, is there a recession or is the economy strong? What are corporate earnings doing? That kind of stuff. What's the latest headline? Is there a war in the Middle East? Are oil prices going up or going down? Stuff like that can influence what I think stock prices will do over the next few days, few weeks, few months. But if somebody said to me, hey, what about stock prices 10 years from now? I start thinking about, is this economy fundamentally sound? What's our competitive position relative to the rest of the world? Are we passing laws that make it impossible to do business in the United States? Or are we passing laws that would encourage people to do business? And so we form expectations, but they are of a different nature. And then, according to this expectations theory, and if this doesn't work, then supply and demand doesn't work. People aren't trying to get rich. But according to this, then those expectations will shape our yield curve. And That's not the end of the story, though, but it is what gives these little wiggles and twists and turns to the yield curve. The way I drew that first one, I was just making up numbers and so forth. But yield curves are, sometimes they'll be very steep and then just flatten out on you. Why? Expectations. Now, there's something else to be put in the story here, and it's working at the same time as expectations. And this goes by different names. The second theory that I'm going to talk about, I'm going to call it liquidity preference. But what it comes down to, whatever theory or whatever label you attach, it comes down to avoiding interest risk or interest rate risk. I used a term last time when we were talking about default risk. I said that people are risk averse. Well, we are averse to interest rate risk. You remember this idea of interest rate risk? I drew the little picture before, and then we've got, here's interest rate, and over here is bond prices. And this is not only bond prices, but loans can be sold in the marketplace, so it's the value of the loan in the marketplace. But I drew this, and then I showed that if interest rates go up, the value of these loans and securities goes down. Remember that? And then also term to maturity, where the loss is small for short-term securities and loans and large for longer term. Remember all that discussion? Well, that's the second thing that's operating here. And so the attempt to avoid that interest rate risk, stability is what we like. Okay? Liquidity is an attribute assets have. Liquidity is the most liquid of all assets, a dollar bill. You know what it's going to be worth, $1. But the thing is, if we get a 30-year bond, what's it going to be worth? I don't know. The interest rates fluctuate a little bit in the market, and a 30-year bonds price goes way up and way down. It's not very liquid. It's not very much like cash. And so people don't feel good. They've got a preference toward certainty and stability. And so what this says is people will try and avoid these 30-year loans and try to focus on the 1 month to 12 months. They'll try and focus on shorter term. There's a preference for that. And so if we had, here's supply and demand, two graphs. If we started off, here's 1-year loans and here's 30-year loans. And let's say they're both paying 5% to begin with. 5%, 5%. And then if we come in and say, hey, what about this preference for liquidity, this avoidance of interest rate risk, then what we'd see is this, is people go, yeah, this makes me nervous. 30-year bonds, that makes me nervous. And so then the supply of funds would start moving to avoid that kind of risk. And then what we would have is this, greater supply of funds here, S2, less supply of funds here, S2, and then maybe this interest rate would go up to 5.7%, and maybe this one would go down to 4.1%. And now when we draw our yield curve, just considering this one factor alone, 1 and 30, what did I have? 4.1, 5.7, upward sloping yield curve. Now, here's the final point. The real yield curve that we see is both of these theories put together. And so this is always with us, regardless of our expectations about the future. If we think interest rates are going to stay exactly where they are today, short-term rates are not going to change, there's no expectations built in this, we're going to have an upward sloping yield curve. And then when we superimpose the expectations on top of that, we'll get a yield curve that may look a little bit wiggly or may even slope downward, but it would be because of expectations on top of that liquidity preference or that attempt to avoid that interest risk. It's both of those theories working together. That's it for today. We will finish up this material on interest rate differentials next time. So long.